I am Mrs. S. Abubaker and welcome to Part 3 presentation on the IFRS 3 amendment that is effective from 1 January 2020. In Part 1, we introduced the concentration test and general overview. In Part 2, we addressed numeric application of the concentration test. In this Part 3, we will look at the nature and risk of the identifiable assets to assess if they may be grouped as one. As noted in the previous video, paragraph B7b requires assessing if the assets acquired are a group of similar identifiable assets or are from the same class of assets. When assessing if the assets are similar or if they fall into the same class of assets or not, the guidance is set out in IAS 38, Intangible Assets, IAS 16, Property, Plant and Equipment, and IFRS 7, Financial Instruments Disclosure may be used. In B7b, further guidance is provided in subparagraph C, D, and E. Subparagraph F specifies what combinations may not be treated as similar assets. Go to your IFRS textbook and highlight these and know where it is for easy reference in an exam or test. Let's look at paragraph B7bF. In the first combination not considered similar is tangible versus intangible assets. We can see that, for instance, if an entity purchases production machinery along with clothing designs, these assets should not be considered similar as their nature is different. Tangible assets in different classes are also discussed in IAS 16 and would typically be tangible assets that are not of the same nature and are evidently different. On the other hand, assets that are both tangible but share different risks that cannot be cost efficiently separated, like the land upon which a building has been built. These cannot be separated from a practical perspective, as the land cannot be sold without the building. Such assets may be combined. Although it might seem straightforward that inventory is obviously not PPE, in practice, this could prove to become confusing. If you look at point 6, assets in the same class could also have different risks. For example, let's say an entity is a property developer and dealer, and therefore the construction of property is typically the inventory. However, the building that the entity operates from, where they keep their hardware and construction raw materials, and also consult with their clients. This building is then a place of business, and the accounting nature of this building would be PPE. From an accounting perspective, these buildings could be mistakenly grouped. This becomes even more complex where intercompany transactions are involved between parent and subsidiary. So let's move on to looking at examples. These examples cover the application of the concentration test and further assessment where applicable. This example is from the Part B IFRS textbook, illustrative example IE 74. So in example A, an entity purchases 10 single-family homes that each already have a lease in place, meaning that these homes already are receiving lease rental income. So they are outputs, which is rental income. Paragraph B indicates that outputs are not required for an integrated set of activities and sets to qualify as a business. The scenario goes on to say that the fair value of the consideration paid is equal to the aggregate fair value of the family homes acquired. Why give this information? Well, this says that there was no resultant goodwill or nothing additional was paid or significantly additional was paid. In Part 2's video, the excess that was added in the concentration test we said is attributable to a substantial process in place. So the larger that is, the less likely the concentration test is met. These family homes each have different sizes and features, which doesn't make a difference because they carry similar risks. The scenario further reads, each family home includes the land, building and property developments. So going back to what we discussed in the previous slide, subparagraph D would apply to the building and the property improvements as they are both situated on the land. They cannot be separated cost effectively and would be impractical to separate. Similarly, the lease contracts in place on the buildings cannot be separated from each other, as in terms of B42, a separate lease asset may not be raised. Therefore, the building and the in-place lease for each family home is considered a single identifiable asset. Now, each of the 10 family homes are considered single identifiable assets. The scenario further reads that their tenants are all of the same class, indicating that the target market is the same, which indicates that they have similar risk profiles. Since each of these 10 homes are similar in nature and risk, they may be grouped. Furthermore, there are no skilled workforce or employees or any other process was acquired. Therefore, in terms of the concentration test, substantially all of the fair value acquired is concentrated in this group of similar identifiable assets, and the concentration test is met, and the acquisition is not a business. We will touch on other aspects in the next video, so keep watching.